Existing home sales slipped slightly in June, but home prices continued their seasonal climb, all while tensions between the US and Iran are heating back up, which could lead to continued rising oil, inflation, and mortgage rates as a result. The bigger question now is whether that becomes a short term headline or the start of another round of inflation pressure. Good afternoon. We had a quiet week in the markets last week in general sense because there wasn't headline breaking news related to inflation, jobs, or Fed news. This week is definitely kicking off in the wrong direction as the US and Iran have reignited the war over the Strait of Hormuz over the weekend with continued attacks rolling into Monday morning. That has caused the 10-year treasury to climb above the 4.6%, which caused mortgage bonds to sell off this morning, starting mortgage rates off higher to start the week. Let's dive into what took place last week and how it affects the real estate market. Here are your headlines. After rising for 2 consecutive months, existing home sales slipped 2.4% from May to June, reaching a seasonally adjusted annual rate of 4.09 million homes. Despite the monthly decline, sales were nearly 3% higher than a year ago. Housing inventory also edged lower from May, but remains 1.3% above year ago levels. So, what is the bigger picture? Lawrence Yun said it well. Buyers right now are extremely sensitive to any movement in rates and affordability, and we are seeing that play out in real time. When rates tick up even slightly, demand pulls back. When they ease a little, buyers come back into the market. That kind of hair trigger response tells you there's a significant amount of pent up demand sitting on the sidelines, waiting for the right moment, and that is not a sign of a weak market. That is a sign of a market with a lot of fuel ready to ignite. Now, the inventory picture is better than it was a year ago, and I will give it that, but better than last year and actually sufficient are two very different things. We are still undersupplied by any reasonable historical measure, and here is why that matters. If demand picks up faster than supply can keep up, which is exactly what happens every time rates drop even modestly, prices are going to feel that pressure almost immediately. The bottom line is for buyers who are waiting for prices to come down before they jump in, the conditions that would need to exist for that to happen are not present in this market. Limited supply, pent up demand is not a recipe for falling prices. It's actually a recipe for the opposite, and the data keeps pointing in the same direction. Now, Fed Chair Kevin Warsh has launched 5 new task forces focused on improving how the Federal Reserve gathers economic data, communicates with the public, and evaluates key areas such as inflation, jobs, productivity, and its balance sheet. So here's my takeaway. This is one of the bigger things that stood out to me most about Warsh, and I think it's being underreported. He's not just talking about changing how the Fed communicates, he is restructuring how it thinks, bringing in former Fed officials, international central bank leaders, and business executives is a meaningful move, and the fact that he wants recommendations from all 4 task forces by the end of the year tells you this is not just a PR exercise. He put a deadline on it, and that is someone who intends to act. Now, for the mortgage and real estate world, this matters. How the Fed evaluates economic data directly influences when they move on rates. And if Warsh modernizes that framework, it could mean a Fed that responds to real time conditions rather than lagging indicators that are already months old by the time they hit the report. That would be a good thing for everybody. Now, new unemployment claims came in at 215,000, holding at roughly the same level for the third straight week. Meanwhile, continuing unemployment claims remained elevated at 1.814 million. So what I'm paying attention to is that the jobless claims look relatively healthy on the surface, but it does not tell the whole story as always. A meaningful chunk of people who lose their job right now are not filing for unemployment. They're jumping straight into gig work because it pays better for the short term than the benefit check. So the claims data looks cleaner than the actual market underneath it. Now, the continuing claims number is one I keep coming back to. When it stays elevated, it means that people who are out of work are taking longer and longer to find their next opportunity. That is not a sign of a tight labor market. That is a sign of one that is getting harder to navigate for the people actually in it. The headlines say one thing and the details say another. And in my experience, the details are almost always closer to the truth. Big week ahead. This morning kicked off things with June CPI. Tomorrow will bring PPI, and Thursday is a heavy day with retail sales, jobless claims, pending home sales, and home builder confidence all at once. Friday wraps up with June housing starts and builder permits. a full slate in a short amount of time. Investors will also have an eye on oil prices all week. Now, as we have covered, crude has been the biggest driver of elevated inflation readings, and any movement there will feed directly into how the market interprets the CPI and PPI numbers. The other thing worth noting is that the Fed futures are currently pricing in an 87% chance of a rate hike by the end of the year. That is a significant shift and tells you the market is not expecting rate cuts anytime soon. Hot inflation data this week pushes that probability higher. Softer core readings could start to bring some relief back into the outlook. A lot can move this week, and I'll be in touch with a full breakdown next week. But for now, have a great rest of your day.